Welcome to the Deep Dive, where we take your sources, your articles, your research, your notes, and really try to extract the most important nuggets of knowledge and insight. Our mission. Well, it's to give you a shortcut to being truly well-informed, complete with, hopefully, some surprising facts and just enough humor to keep you hooked.
And today, we're doing a custom deep dive for you into the Q1 2025 earnings analysis for Illumina, Inc. That's ticker symbol ILMN. And look, this isn't just about reviewing numbers on a page. It's really about understanding a company's performance in the broader context of market expectations, what it all means.
That's exactly right. We're using our structured five-part framework to analyze their latest press release. We're integrating their official data with, real-time market insights. Our goal here is to move beyond just the headlines and uncover what truly matters for understanding this company's financial health and its future. We want to give you that critical context behind the numbers. Now for slide 1, the at-a-glance scorecard. So this is where we get that high-level summary, right? Illumina's Q1 performance against what Wall Street was expecting, and crucially, how the market reacted immediately.
Yeah, and what's really striking here is, well, it's a bit of a mixed picture. On the bottom line, Illumina reported non-GAAP diluted earnings per share of 97 cents. Now, this actually surpassed the consensus analyst estimate that was somewhere between 94 and 96 per share. So technically an earnings beat.
An earnings beat. Okay, that sounds good on the surface, right? But you said a mixed picture. What about the top line, the revenue?
Well, that's where it gets less exciting. Their core Illumina revenue, that came in at $1,041 million. And that was pretty much in line with the Wall Street consensus forecast, which was about $1.04 billion. So no big surprise there.
Okay, so beat on earnings, in line on revenue.
But here's where it gets really interesting for you listening. Despite that earnings beat, the market's reaction, it was negative. Illumina's stock price actually declined by about 2.87% in the immediate after-hours trading.
Hold on. Beat on the bottom, met on the top, but the stock dropped. Okay, what gives? That doesn't immediately add up.
Right. It seems counterintuitive. But the negative reaction was really driven by the company's forward-looking guidance, what they said about the future. Initial analyst and investor sentiment, it really zeroed in on Illumina's decision to lower its full-year financial outlook. That signaled some significant business challenges coming up. Things like, geopolitical headwinds, tariffs, and those future worries basically overshadowed the solid results they just reported for Q1.
Okay. So the future outlook trumped the past performance. That makes more sense. Investors are always looking ahead. But let's dig a bit deeper into the Q1 numbers themselves for a sec. I noticed this huge disparity when looking at the year-over-year growth. Total revenue, it saw a slight decline, right? 1.4%. So $1,041 million this quarter versus $1,056 million a year ago. Not dramatic. But then GAAP net income shot up by a massive 87.1%, and GAAP diluted EPS jumped 86.4%. How do you get that huge profit jump with slightly lower revenue?
Yeah, that disparity is absolutely crucial to understand. It's a fantastic question. It's definitely not about the underlying business suddenly taking off. Not at all. Instead, it's primarily down to a pretty substantial shift in the company's expense structure compared to last year. Specifically, there was a sharp reduction in their selling, general, and administrative expenses, SG&A, on a GAAP basis. Those fell from $336 million in Q1 2024 down to $267 million in Q1 2025. Now, why? Because the prior year, Q1 2024, included significantly higher costs, things related to acquisitions, other non-operational stuff. So Q1 2025 saw what we'd call expense normalization. It's like cleaning up the mess after a big project.
Got it. So the massive bottom line growth isn't really about booming current operations. It's more like they stopped spending on those big one-off things from last year. Cleaning up the books, that's a really critical distinction for anyone listening.
Exactly right. It changes the interpretation completely. And just a quick note on that diluted EPS, the $1.82 GAAP figure. Remember, diluted EPS gives you a more conservative view because it factors in the potential impact of things like stock options or convertible debt. It's kind of a worst-case scenario for existing shareholders' ownership stake.
Okay, good clarification. Right, moving to slide 2. The engine of profitability. This section is all about dissecting the quality of Illumina's earnings by looking at their profit margins. How efficiently are they turning those revenue dollars into actual profit? And I think you said there's a tale of two measures here.
That's right. On a GAAP basis, looking purely at the standard accounting numbers, the company showed pretty significant margin expansion. The GAAP operating margin rose to 15.8% in Q1 2025. That's a really substantial improvement from 11.0% in the same period last year. Looks great on the surface.
Okay, GAAP margin up significantly. But you mentioned two measures. What's the other one? And how does it maybe tell a different story about the core business health?
Well, The other measure is the non-GAAP operating margin. This is the one management often highlights because it adjusts for certain items like acquisition costs, restructuring charges, things they see as not part of the regular ongoing business. And that measure, the non-GAAP operating margin, was largely stable. It came in at 20.4% this quarter, compared to 20.6% in Q1 2024. Basically flat.
Ah, okay. So that stability in the non-GAAP margin, that suggests the fundamental kind of repeatable profitability of Illumina's core business hasn't really changed much year over year. So that big jump in GAAP profit we talked about earlier, it really wasn't driven by the core operations getting suddenly more efficient.
Precisely. You've got it. The dramatic improvement you saw in the GAAP margin, it's almost entirely down to those non-operational items we discussed before being lower this year. Things like non-cash amortization of acquired intangibles. That's basically an accounting charge, not cash out the door, that helped by about $17 million compared to how it's treated in GAAP versus non-GAAP. Plus, cost tied to restructuring activities, another $31 million difference. Those things get excluded from the non-GAAP calculation.
So connecting this back to the bigger picture for our listener, by looking at that stable non-GAAP margin, you can reasonably conclude that the underlying business is performing pretty consistently. And that aligns much better with the modest 1.0% year-over-year decline in non-GAAP EPS, right? It suggests the core operations are steady, not suddenly booming like the GAAP numbers might imply at first glance.
Exactly. It paints a much more realistic picture of the ongoing business trends.
All right, next up, slide 3. The engine room business segment performance. So to really understand the drivers behind that overall revenue figure, that $1,041 million, we need to break it down. Are certain parts of the business doing better than others?
Well, technically, Illumina operates as just one reportable segment, which they call core Illumina. But crucially, they do give us a revenue breakdown by type. You've got product revenue and then service and other revenue. And this quarter, these two streams actually moved in opposite directions, which is quite interesting. It tells a story.
Opposite directions. Okay, tell us more about that. Where's the strength and where's the weakness?
So their largest and, frankly, most critical revenue stream is product revenue. This is where you find sales of their sequencing instruments and, importantly, the highly recurring sales of consumables. You know, the chemicals and kits needed to run the machines. Some people call this the razor blade model, right? Sell the razor cheap, make money on the blades. This product revenue accounts for about 85% of their total revenue, and it actually showed really good resilience. It grew slightly by 0.5% year over year. Went from $876 million in Q1 24 to $880 million in Q1 25. That stability in their core product business, that's definitely a positive indicator.
The classic razor blade model. Yeah, like getting you hooked on the coffee pods after you buy the fancy machine. That sounds like a solid foundation for a business. So if the core product business, the biggest part, is stable, but total revenue declined overall, where did the drop actually come from?
Yeah, good question. The contrast comes from the other, much smaller category, service and other revenue. That category saw a really sharp drop at down 19.5%. It fell from $200 million last year to $161 million this quarter. Now, the primary reason for that decline was apparently the timing of revenue from a large strategic partnership that hit the books in the prior year quarter, in Q1 2024. So it created a really difficult year-over-year comparison. It wasn't necessarily that the base service business suddenly collapsed.
Okay, so what does this all mean for you, the listener? How should an investor interpret this specific breakdown? Is the overall revenue decline less worrying then?
I think so, yes. This context suggests the weakness was really concentrated in a more volatile, less predictable revenue stream, and it was largely due to a tough comparison point from last year. It wasn't necessarily indicating a fundamental rot or deterioration in the core service business itself. Therefore, yeah, the headline revenue decline looks, frankly, less concerning when you break down its components like this. It really underscores the importance of looking inside the numbers, not just at the total.
Absolutely. Okay, let's turn to slide 4, financial strength and shareholder rewards. This section assesses Illumina's financial health looking at the balance sheet and examines how they're prioritizing their capital allocation and rewarding shareholders. Because, you know, strong fundamentals are always key, especially in uncertain times.
Absolutely. And it raises that important question for any investor. Just how stable is the company financially? Well, Illumina maintains what I'd call a moderately leveraged balance sheet. As of the end of March 2025, they held total debt of about $1.99 billion. That was against total stockholders' equity of $2.37 billion. So doing the math, that gives you a debt-to-equity ratio of 0.84. That level isn't generally considered excessive. It suggests they still have decent financial flexibility. They're not drowning in debt.
And they seem to have strong liquidity too, right? Cash equivalents, short-term investments totaling $1.24 billion. That's a pretty solid cushion, a good foundation to weather potential storms.
Definitely provides a safety net. Now, regarding capital allocation, what they're doing with their cash flow, their actions in the quarter signal a very clear priority right now. The company generated a healthy $208 million in free cash flow. That's cash from operations minus capital expenditures. And they deployed nearly all of this $200 million, to be precise, to repurchase their own shares on the open market.
Wow, using almost 100% of free cash flow for buybacks. Especially, as we discussed, while they're guiding for a revenue decline. That really screams defensive capital posture, doesn't it? What kind of message does that send to shareholders, you think?
It absolutely sends a defensive message. You're spot on. In a challenging business environment, like the one they're forecasting, management might genuinely see fewer high-return opportunities to reinvest that cash back into the business for growth. So this decision suggests a belief that returning capital to shareholders via buybacks is the most prudent use of cash right now. Buybacks reduce the number of shares outstanding, which can help support the earnings per share and potentially the stock price. It can also be a signal sometimes that management thinks the company's stock is undervalued, which frankly is plausible given that negative market reaction to their forward guidance we talked about. And it's worth noting they still have about $1.2 billion left under their current share repurchase authorization, so this strategy could certainly continue.
Okay, interesting dynamic there. Finally, we arrive at slide 5, the road ahead management's outlook and key takeaways. This is where we synthesize everything, focusing on management's forward-looking statements and extracting the key takeaways that really define this quarter's narrative for you, the investor.
Yeah, and the central theme, really the defining feature of this whole earnings report, was that disconnect between past performance and future expectations. CEO Jacob Thaysen actually acknowledged the strong Q1 revenue and EPS, but then he immediately pivoted to the challenges ahead. He said, and I'm quoting here, "Our outlook for the year has weakened due to shifting policy and geopolitical developments, and we have taken swift incremental actions to protect our earnings." Pretty direct.
Weakened outlook. Okay, so what does that translate to in terms of their actual numbers for the rest of the year? How significantly did they have to revise those projections downwards?
It is a pretty significant downgrade to their full year 2025 guidance across the board. Let's break it down. First, revenue. They now expect core Illumina revenue to actually decline between 1% and 3% for the full year on a constant currency basis. That's a complete reversal from their previous expectation, which was for low single-digit growth. Big swing. Second, geopolitical headwinds. They specifically called out the Greater China region as a key driver of this weakness. Full year revenue there is now projected to be only $165 million to $185 million. Clearly a challenging market for them right now. Third, tariff impact. They put a number on the impact of tariffs. They expect them to add about $85 million in costs, which they calculate will reduce their operating margin by about 125 basis points, that's 1.25%, and lower EPS by about $0.25, tangible impact. And finally, earnings per share. Reflecting all these pressures, the full-year non-GAAP diluted EPS forecast got cut. It's now expected to be in the range of $4.20 to $4.30. That's down significantly from their prior guidance, which is around $4.50.
Wow, okay. So declines expected in revenue, headwinds from China, direct costs from tariffs, and a cut to the EPS forecast. It really crystallizes why the market reacted negatively. The quarter was defined by this major conflict, strong backward-looking earnings beat versus a weak forward-looking guidance cut. And it highlights that crucial point for investors, doesn't it? The future often matters more.
It absolutely does. That negative stock reaction is Exhibit A. It demonstrates that, for investors, a company's future prospects almost always carry more weight than its past results. It's not just about what they did last quarter, but what they think they will do next quarter, next year.
So connecting this all back to the bigger picture for our listener, while Illumina's fundamental business model, that core product engine, seems sound, with stable underlying profitability shown by the non-GAAP margins, the guidance cut makes it crystal clear that external macroeconomic factors are now the dominant forces shaping the company's near-term path.
Precisely. Specifically, it's those tariffs and the geopolitical issues hitting the China market. Those are the main headwinds right now. And, as we saw, in response to this challenging environment, management is clearly taking defensive actions. They've initiated that $100 million cost reduction program, and they're funneling the vast majority of their free cash flow into share buybacks. That whole capital allocation strategy, it signals a clear focus on protecting earnings and supporting shareholder value during this period of heightened uncertainty, rather than, say, aggressively chasing growth initiatives.
It feels like Illumina's first quarter story is really a textbook example of a company navigating a tricky transition. They were moving from a period dealing with complex, kind of messy financials related to acquisitions, cleaning that up, only to run into a new reality dominated by these external pressures. That impressive GAAP EPS growth we saw. Less a sign of a booming business, more a reflection of cleaning up the income statement from last year's costs.
Exactly. And the market, as you said, looked straight past those backward-facing numbers. It fixated instead on management's forward-looking guidance, which painted a picture of a company really grappling with tangible headwinds. So this quarter, you could argue, marks a real pivot point for them, from dealing with internal financial fallout to now bracing for these external challenges.
What a fascinating turn for the company. And that's our deep dive into Illumina's Q1 2025 earnings. What stood out most to you listening? Hopefully, the structured approach helps you see beyond just the headlines and build a deeper understanding of how all these pieces fit together. For me, it's definitely that stark reminder a beat on earnings doesn't guarantee a positive market reaction if the future outlook suddenly clouds the horizon.
Absolutely. And just the usual reminders. This report is purely for informational purposes. It doesn't constitute financial, investment, legal, or tax advice. The information here isn't a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should always be made based on your own research and in consultation with a qualified financial professional. While we've made efforts to ensure the accuracy of the information, no guarantee is provided. Also, this report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions might still occur. All information, including financial data and calculations, should be independently verified by you, the user, before making any decisions.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.